In Part 1, we focused on trading order blocks and fair value gaps formed within the New York session range. In this video, we'll add liquidity as an extra layer of confirmation. This refined approach can help filter out lower probability trades and improve the overall quality of the setup. I'll also show an alternative setup that relies primarily on liquidity. This setup can be used on days when no valid order block or fair value gap is formed within the New York range, ensuring there is still a structured approach to the market. Now let's understand what liquidity is and why it plays such an important role in the market. Liquidity is a collection of stop losses and pending orders resting above highs and below lows. Price is often drawn to these areas before making its intended move. Let's understand this with an example. As price moved higher and then reversed, it left behind these highs. These highs represent liquidity, where many stop losses are resting. In gold, price often hunts these liquidity areas before making its intended move. Simply put, liquidity acts as the fuel that powers the next significant move in the market. To enhance the setup from Part 1, we need to understand the role of liquidity. I'll be explaining this concept using the same trade example from Part 1, specifically the losing trade from June 2, 2026, example number 3, where a stop loss was hit. Now, let's zoom out the chart and look at the bigger picture. As you can see, there is a clear liquidity level on the chart, and price swept that liquidity during the New York session. Whenever liquidity is swept, we need to become more cautious because gold often tends to target the liquidity resting on the opposite side before making its actual move. Once that liquidity was taken, we could then look for an order block or fair value gap that aligned with the direction of the move. Instead of taking the original entry from Part 1, we would wait for price to sweep liquidity first, then from the order block or fair value gap aligned with the liquidity level we may look for a trade. By combining liquidity with our order block and fair value gap rules, we can avoid some lower probability trades and focus only on the setups that have stronger confirmation behind them. Let's take another example for better understanding. This trade example is from June 7, 2026. As the Asian session was about to begin, price swept the liquidity resting at this level. After the liquidity was taken, we could see a valid order block aligned with that liquidity level. This is exactly the type of setup we want to look for. This extra layer of confirmation helps us become more selective and improves the overall quality of our trade entries. Now let's move on to the setup we can use when no valid order block or fair value gap is formed within the New York session range. On some days, the market won't provide a clear OB or FVG according to our rules. Instead of forcing a trade or skipping the day completely, we can use a liquidity-based setup to identify potential opportunities. As on June 20, 2026, we can see that there is no proper FVG or OB in the New York session range. In that case, we will wait for the price to sweep liquidity areas as per the chart. We also need to find OB or FVG aligned with the liquidity level. Once price enters the order block or fair value gap, we can take a trade. In such setups we can aim for more than 1:2, because this is a high probability setup. We can set target as per the risk management or as per the next liquidity level. Let's look at another example from May 18, 2026. In this case, price swept the liquidity resting above this high and then began reversing during the Asian session. Since there was no high probability order block or fair value gap within the New York session range, we used our liquidity-based setup instead. We entered as price started reversing and targeted the liquidity resting below. Price eventually reached the downside liquidity and hit our take profit. This is a high probability setup, but it does not occur very often. That's why it's important to remain patient and wait for the right conditions rather than forcing trades. In these two parts, we've covered a complete approach to trading gold during the Asian session in a way that is both simple and practical. In Part 1, we learned how to trade order blocks and fair value gaps formed within the New York session range. In Part 2, we added liquidity as an extra layer of confirmation to improve the quality of our setups and become more selective with our entries. We also covered an alternative liquidity-based setup for days when no clear order block or fair value gap is formed within the New York range. My goal with this series was not to create a complicated strategy with dozens of rules. Instead, I wanted to share a structured approach that is easy to follow, easy to repeat, and based on how gold often behaves around liquidity. Before using this strategy, I highly recommend backtesting it yourself. Study historical charts, observe the patterns, and see how the setup behaves. The confidence gained from your own testing is worth more than any video. Thank you for watching, and remember, consistency, patience, and risk management will always matter more than finding the perfect setup. I'll see you in the next one.